Hey traders, let's dive into one of the most crucial concepts in trading, the risk-to-reward ratio. Trust me, understanding this could be the difference between consistent profits and costly losses. Imagine you're standing at a crossroads. One path leads to a potential $2,000 profit, but you might lose $1,000 if things go wrong. That's essentially what a 1.2 risk-to-reward ratio looks like. You're risking 1 unit to potentially gain 2. Pretty straightforward, right? But here's where it gets interesting. Let's say you're not just throwing darts at a board. You're making calculated decisions. Think of it like betting on a sports game. Would you bet $100 to win 50? Probably not. But would you bet $100 to win $300? Now that's more appealing. This brings us to the nitty-gritty of setting up your trades. You've got 2 crucial price levels to consider: your stop loss and take profit levels. Think of your stop loss as your emergency exit. If the trade goes south, this is where you bail out to protect your capital. Your take profit level? That's your victory line where you collect your rewards. Here's a real-world example. Let's say you're buying Bitcoin at $40,000. You set your stop loss at $39,000, risking $1,000, and your take profit at $43,000, aiming for $3,000 profit. That's a 1.3 risk-reward ratio. Even if you're wrong more often than you're right, you can still come out ahead because when you win bigger. But here's the catch, and this is something many traders overlook. The ratio isn't everything. You need to consider the probability of success. A 1:5 ratio sounds amazing, right? But if the chance of hitting that target is like finding a needle in a haystack, it might not be worth it. Many successful traders stick to a minimum 1.2 ratio as a rule of thumb. But remember, trading isn't one size fits all. Some market conditions might call for more conservative ratios, while others might present opportunities for more aggressive approaches. The key is to find what works for your trading style and risk tolerance. Maybe you're comfortable with a 1.1.5 ratio if you have a high probability setup, or perhaps you only take trades with a minimum 1.3 ratio because you prefer fewer higher quality opportunities. Bottom line, your risk-to-reward ratio is like your trading compass. It helps you navigate the markets with a clear head and a solid plan. Don't just focus on potential profits. Always consider what you're risking to get there. Because at the end of the day, successful trading isn't just about making money, it's about keeping it too. Remember, the best traders aren't necessarily right all the time. They're just smart about their risk management. So take some time to define your ratios, stick to them, and watch how it transforms your trading journey.